Good evening, everybody, and welcome to our webinar this evening. Thank you so much for joining us. If you have not joined us before, or if you're meeting me for the first time, my name is Chris Entz. I'm a CFP, an advice-only planner, and a member of the support team here at Advice. And these sessions, and this one specifically, we're talking about real estate, specifically real estate in retirement. So looking at the sense of a lot of the users on the platform have gotten this question quite a few times. And how do I model a downsize? What if I wanted to sell and rent? How can I take a look at this? So we're really focusing on the home to say, how can you use that? And most importantly, how can you model out some things on the platform so you can see what the pros and cons of different situations are? So I'll toss things over to Owen in a second to get us into the meat of things. But before we do, a little housekeeping. As always, we want to make these sessions as useful as possible. So please ask questions when it comes up. I'd prefer if you use the Q&A button, which is just at the bottom side of your screen, to send any questions as we go, and I'll feed them to Owen as we go through our evening today. So thanks again for joining us, and toss things over to Owen.
Perfect. Thanks, Chris. Yeah, my name's Owen Winkelmullen, advice-only financial planner and CFP, and the founder of Advice. Yeah, as Chris mentioned, in this session, we're going to be going through kind of selling, downsizing, using real estate to help fund retirement. I'm going to bring up the slides here. We're going to go through some just basic fundamentals, just to ground ourselves before we get into some of the case studies. Now, this is an interesting topic because there are some sort of personal planning components to this, as well as some financial planning components. So it's one of those interesting pieces where it's a sizable decision. The numbers are quite large. There's financial impacts and also personal impacts. And so we want to highlight maybe a bit of the both sides of that conversation, both how to model it out on the platform itself, but also maybe how to think about some of those softer factors as you're kind of approaching retirement, thinking about downsizing or selling in the future. So let's talk about some of the general things first, and then we'll get through the case studies and how to actually implement some of this within your plan. So we're going to go through how to use a principal residence to fund retirement. And of course, a couple of different options there that we'll explore together. We're going to look at, if we have time, how to use a rental property to fund retirement. So, single, 2, 3, 4 rental properties. We'll look at an example. One of those case studies will be for a retiree who's comparing different ways to use the principal residence to fund retirement. Another one with a multiple rental property owner who wants to sell maybe 1, 2, or 3 rentals to help fund retirement spending. We'll cover all that within the next hour or so. Now let's start with some of the basics around principal residence. So when we talk about principal residence, really it can be multiple types of, it could be a home, cottage, condo, apartment, vacation property. There are certain rules around this. Definitely talk with your tax professional, financial planner, accountant about what qualifies, but as long as you're living in that property for some time during the year in general, then you can use the principal residence exemption. So if you have multiple properties, if you have a cottage, vacation property, a home that fit this definition, you could use your principal residence exemption on any of those. And so, although we'll model this out for a home, for some of you, there might be the use case of using this on a cottage property or something that's gone up more in value. So definitely talk with your financial planner, talk with your accountant about what makes the most sense to use the principal residence exemption for. Of course, the big benefit here is there's no capital gain on the sale of a principal residence. So definitely a big benefit there. Now, the reason why that's a big benefit, of course, home prices are quite high across the country, definitely gone up over the last 10, 20 years. And depending on where you live, could have been significant increases. So not only have you avoided capital gains using the principal residence exemption, but you've also probably got quite a bit of equity tied up in your home, your principal residence. And so again, depending where you are across the country, that could be a significant amount of financial assets. And really, when we're talking about retirement planning, it's, how do we use those assets, both real estate assets and financial assets, to help fund retirement in the best way we can. So early retirement spending, more on travel, activities, hobbies, entertainment, etc. How do we make that possible using all of the assets that we have, not just financial assets? So can we use a primary residence to help fund retirement? Yeah, there's 3 different ways often we'll see. So one is the downsize, more traditional way. selling a current principal residence, purchasing a less expensive home. This frees up some of the equity in the home. Maybe it's a large single family home, you're moving to a condo or a smaller townhouse. You might be freeing up a few $100,000 or more through that downsize. So that's definitely one option, what a lot of people think about when they think about tapping into their home equity. Now, the other option is selling and renting. Now, we'll talk through some of the pros and cons here as well, but selling and renting would really be the full on sale and then investing the proceeds in renting after. So pros and cons there, more flexibility, and we'll talk through that. And then the other one is accessing the equity through some sort of borrowing. So home equity line of credit, reverse mortgage, and we'll show you an example there as well and how that can maybe help push out the sale of the principal residence a little bit. So could be a good option in certain circumstances, and we'll show you how that gets set up. If there's any questions, Chris, just stop me along the way. But let's talk about downsizing. So couple key considerations here, and we'll see that when we model it out on the platform, but definitely the first one is the transaction fees on the sell side. So again, depending on where you live, depending on the size of the transaction, we might see 3 to 7% of the property value go towards those transaction costs. So big consideration there. If we don't include those transaction fees, definitely looks a lot rosier, the downsize, than it will actually end up being. Same with the purchase. So, if we're downsizing, we got both sale costs, purchase costs, transaction fees on both sides. Could be land transfer tax, lawyer fees, moving costs. Could also be renos on the home, right? New home, want to make it yours. There could be changes there that you need to make that could be 10, 20, $30,000. We've definitely seen this with clients. So we need to include some of those costs as well. We don't want to be, again, too optimistic with the proceeds that we're expecting from the downsize. So both of those easily could eat up into 10 or more percent of that downsize. And of course, change in housing costs. Now, this is interesting because you'd think with a smaller home, we'd have less housing costs. Not necessarily the case. If we're moving into a condo, depending on the amenities, we could see condo costs easily be flat versus owning a home. So we could see the total cost of ownership remain relatively similar month to month. So not necessarily will we see that drop dramatically if you're downsizing. So definitely something to think about as well. Now, in the sell and rent, a couple things that we want to think about is, again, the sale cost for sure. That's going to be a factor, but also the investing of the proceeds. So certainly a factor in the downsize scenario, but a much bigger factor in the sell and rent scenario. So you may, if you've got a pension, for instance, or both you and your partner have a pension, you may not have a very big investment portfolio. Selling and renting, selling your primary residence and renting could easily double, maybe even triple the size of your investment portfolio. You could go from 500,000 to at least 1.5 million, depending on the size of the home and where you are. So this is always a big factor that we want to highlight, is that there is a psychological sort of barrier here, is investing the proceeds. Do we lump sum? Do we dollar cost average? What's the tax implications of having another $1 million in investments, or 500,000? Not all of that's going to fit in the TFSA, unfortunately. So what about those non-registered investments? How do they get taxed? How do we track the tax treatment, adjusted cost base, etc.? We probably sometimes gloss over this aspect a little bit, but it's a very important thing to think about, is what do we do with all that money? We need it to grow because we have to pay for rent going forward. And of course, that's the last piece, is just what's a reasonable renting cost? If you've been, a homeowner for the last 20, 30 years, it could be hard to sort of imagine how much that rental cost is depending on where you live. So that's always something to investigate beforehand, is what, for your lifestyle, what's a reasonable renting cost? Now we've got some examples here from across the country. Maybe it's 2 or 3,000, but again, depending on what you're used to, size of home, size of a condo you want to downsize to, it could be more than that. So we want to think about what's the rental cost in the future. Now, some benefits to the renting that maybe we didn't cover here is that there's certainly more flexibility. So one of those things to think about is if you've got sort of adult children, they're in another part of the country or in different parts of the country. One of the things we often talk about is downsizing, selling, and owning versus selling and renting and having more flexibility for a period of time. So that's also something that we want to consider, more soft factor. Now in the platform, a couple things that we're going to take a look at together, but we want to know what's the purchase price for that future property. do a little bit of work to investigate what's reasonable there. We want to know what are the closing costs on that property as well. So, in this case, maybe some land transfer costs, etc. But again, might be renos depending on what sort of home you're moving into. And of course, what's the purchase date? So when are we planning to do this? Generally within the year is fine. Doesn't have to be exactly to the month and day. And then on the sale assumptions, the big factor is, of course, the sell price, which should be matching your asset value in Discovery and Assets, but also what's the reasonable fees that we're going to be paying here. And again, there could be additional fees for prepping the home for sale. It could be also lawyer fees, real estate fees, moving fees. Could be a number of different things there that we need to include. And of course, the purchase date, sale date as well. And then the last piece in the platform is because we can have different phases of retirement spending, we might set up a different phase that is post downsize. And that expenses phase, for individual expenses might drop for property tax or utilities, etc., but might go up for condo fees. So again, we might not see as large a drop as you might be expecting. So always a good exercise to do that bottoms up to say, okay, what's reasonable given all of these different pieces. Now, before we take a look at the example, let's talk about lending and borrowing. So two different ways to do that. One would be a home equity line of credit. This lets you sort of borrow against the house, obviously, but typically easier to set up before retirement. So when we speak with clients, we're often talking about doing this, setting this up before you retire. Easier when you've got an income from employment, but you can still set it up after as well. So something to think about as you enter retirement. But a home equity line of credit is one way to maybe use the equity in the home, at least on a temporary basis. Interest rates typically variable, so that's something to keep in mind as well. Now, the other option is a reverse mortgage. So here, a little bit different in terms of how much we can access, when we might do it. Also, the repayments a little bit different, and interest rates could be fixed or variable. So different factors here, different considerations, but also an option in terms of borrowing against home equity. Now, some things to think about, estate goals. So depending on the type of sort of borrowing that you use, if you want to keep the home in the family, it's a family home, it makes it a bit more difficult if you're borrowing against the property. So definitely something to keep in mind there. Future goals around home ownership and leaving it to the children. Housing priorities, this is often a big factor, is just how long do we want to stay in the home? Sometimes this can be just a temporary thing. We're going to borrow temporarily just to stay in the home for another 3, 4, 5 years. And so that's one of the options. One of the advantages here is that it could allow us to stay in the property just a little bit longer. And of course, borrowing rates, we've seen them fluctuate a lot over the last 4 or 5 years. Big factor here to consider as well, and whether or not they're locked in or they're variable. So lots of considerations around borrowing, what the time period is, what the cost is as well. Now let's get into the case study unless there's any questions, Chris.
No questions, but just a comment to add to how important it is to kind of note that strata or condo fees are often significant.
Mm,
And they just kind of added the comment that they're in some places likely to increase with legislation for reserve funds or insurance or long-term reserve funds. It really depends on the building and some of those other factors. So it can it can make a big difference.
yeah, actually, great point. And even special assessments, right? Depending on where you are in the country, we see that be more prevalent in certain parts versus others. So even though we might have a certain amount for condo fees, we might need additional sort of savings for that if that happens.
And when we're looking at the case study, one of the things we want to factor in is just how much resilience do you have for some of these more unexpected things to say, oh, there's a bigger rent spike than I expected, or my condo fees went up a lot, or there is a special assessment. Like, are you able, the success chart isn't going to capture everything there, but we can see where we can see resiliency in your plan and where there might be some vulnerabilities to anything that changes there, which we'll take a look at when we're looking at the case study.
Perfect. So yeah, let's kind of frame this up here. So we've got Al and Jane, so they're approaching retirement here.
Sorry,
Want to
Owen,
know,
could I just
yeah,
take one more just because it kind of connects to the last thing and I want to make
yeah.
sure we get to it before we just had a question. Can you expand on strategies to get a HELOC after retirement?
Mm,
So, for example, if you have lower income.
yeah, definitely a bit more challenging after retirement. pension income, CPP old age security definitely will get considered, um, but a little bit harder. So, this sort of idea of like an asset-backed mortgage or kind of home equity line of credit, not really a thing. Definitely possible, but a little bit more difficult. So, even if you had some investment assets, they might be more reluctant to lend. Funny thing is, like if you have it set up right before you retire and you've got your employment income, it just seems to be easier, and they don't necessarily reduce it in the future. Obviously, always a risk with a home equity line of credit. They can always reduce your borrowing capacity. So that's definitely a risk to consider as well. But from an ease perspective, certainly something to think about before you retire. That being said, as long as you're not going to use it to go buy an RV or something like that, right? That's not in the plan. So as long as you're not tempted to use that available home equity line of credit, then by all means get it set up ahead of time.
Great. Thanks, Owen.
Okay, so let's talk about Alan Jane here. So approaching retirement, 58, 60, can we retire? That's the question. Do we sell and rent? Do we downsize? Do we keep the home? What's the different options there? When should we take CPP and OAS? So that's one of their questions. What success rates acceptable? And we'll kind of take a look at their spending. So we'll get a sense of how much they want to spend here as well. Financial assets, so 1.6 million, so quite a bit in financial assets. Reasonable fees, fairly aggressive, assertive investors, 80-20 asset allocation between equity and fixed income. Part of that reason could be that they have a small pension, 25,000 a year. So that's also maybe a little bit of their fixed income, more stable income for retirement. So that's kind of where they are at the moment in terms of spending. And I think this came from somebody emailed this in, right, Chris?
Yeah, we love this. So if you have a scenario that you want us to take a look at in a case study, this came from a few months ago, but they were saying, could you take a look at something like us? So it isn't exactly them, but it definitely uses some of their numbers, and it's fun to kind of use real life situations to kind of to shape some of these case studies. So please send them on in if we want us to build something kind of like you.
Perfect. Um, so I think in this example, we didn't have a bottoms up spending estimate. So we've got 11,000 a year early retirement, 10,000, sorry, 11,000 a month early retirement, 10,000 a month middle retirement, sort of slow go, 8,500 in the no go phase towards end of retirement. Now, we don't have, again, their detailed budget, but we did assume that in general, out of that 11,000, 10,000 a month, about 1,000 a month is going towards housing costs right now. So we've said about roughly 12,000 a year. The reason why we bring up that assumption is we're going to include that when we do the rental cost assumption. Perfect. I think we can flip over then. So let me bring up our example. And we'll talk through the downsize scenario, but let's first take a look at the don't sell scenario because it's not terribly successful. So it does sort of highlight that we do need to look at options here. Now, their spending was quite high. They have the pension, CPP, OAS, but we can see here that if they don't sell or downsize at some point, um, we do have to start tapping into home equity here. So we can see there's some debt building up. At about age 80, we're starting to run out. There's still some estate value. So, this is reasonable. We could make this work potentially with a borrowing against the home, but still not quite. We're borrowing a fairly large percentage of the home value. So I want to start with this, of course, sort of saying like, unless we find a way to fund that extra retirement spending, we would need to look at reducing it somehow. And we can kind of see here it need to go down, using the AI strategy, we can see it would need to go down between 18,000 a year and 24,000 a year. So downsizing is quite impactful in this plan because it does allow them to spend a fairly significant amount more in retirement. So I want to highlight that as the base scenario. But let's first go through then and show you how to set up the sale of the home. So in profile, we want to start down here. We'll go to financial profile. What we want to do is we want to make sure we have both the homeowner selected. They obviously own a home. They're going to be downsizing. But we also want to make sure we have the home purchase and sale selected. And the reason why we want that is because then in foundation, we'll have some additional sections that ask around questions around buying and selling a house. So if you don't have buying a house or selling a house in foundation, just check your profile and make sure these two are selected. Now let's start with buying a house. So if this was a first-time home buyer, we would want to fill out the column on the left here. We'd want to look at mortgage affordability, etc. Not a factor for Al and Jane because we're selling a home and downsizing. So they're going to use the proceeds of the sale to purchase the new home. So really just the middle column is what we'll focus on here. They're going to purchase a smaller condo maybe for 450,000. They have 100% of the down payment. It's coming from the sale of their primary residence. And we've estimated 15,000 for closing costs. Could be a new condo. There's no need to plan for renovations. It's just land transfer tax, bit of lawyer fees. So total, we need 465,000, and they have it all because it's all coming from the downsize. So current down payment savings is the entire amount. And roughly we've got 2026 as the date, but again, could be any time during the year. We don't have to worry about mortgage because there's no need. They're funding it entirely with the proceeds of the sale. So let's go over to the selling a house section. So here we really just need to know what's the sale price, and that should match the asset value in Discovery Assets. And we need to know the cost of sale as a percentage. And again, varies across the country, varies depending on the size of the sale. Here we've assumed 5%. And this could also include things like, again, prepping the home for sale. It could include costs around lawyers' fees, staging, etc. So not just the realtor fees, but also additional fees on top. And again, sale date anytime within the year, as long as it's the same year as the purchase, just so the platform can use the cash from one side and the other. Excellent. Any questions so far here, Chris?
No, not about that part.
Super. Okay, so we've got buying a house and selling a house entered. In general, if we're looking at different scenarios, we recommend starting with the downsize. So even if you want to do a sell and rent, if you also want to do a downsize, we recommend starting with the downsize as the base assumption. It's easier to back out some of the other kind of purchase assumptions after you've got it all entered. So now that we've got that in, let's take a look at the initial scenario here. And we'll kind of walk through what it looks like from a sale perspective. So let's maybe start with net worth. So here we can see the sale already. So we can see their current real estate sold. So we've got less in terms of real estate value. We can see that the non-registered jumps up quite a bit. So from 200,000 to 400,000. And we can see the TFSA goes up a little bit as well. So it goes from 179 to about 212. The platform will try to use the TFSA as much as it can. So if you've got additional TFSA contribution room, great. Platform will take it all, use that first, and then it will use the non-registered after. So here we've got that already. The platform's doing that for us. For spending, we have a slight increase in spending here. So that the platform is adding, we can see here $60,000. It's $45,000 on the sale, $15,000 on the purchase. And then there are proceeds. So proceeds of the sale, after the additional costs, we have about 284,000. So that's what the platform is doing to add to the TFSA and the non-registered accounts. Now it's not quite the full 400 plus thousand because we need to pay for sale costs, but we also need to pay for living expenses that year. So you'll notice first year of retirement, we've got some non-registered withdrawals. Second year of retirement, there are no non-registered withdrawals because we have the proceeds cash flow from the downsize. Even if it happens during the year or later in the year, the platform sort of sees that cash flow and it may not plan a withdrawal. In reality, you might have a withdrawal and then a recontribution, but even in this case, we still might want to plan some RSP withdrawals just from a tax planning optimization perspective. So we'll take a look at that next. But that's the basic downsize scenario. Now, as we can see, there is money left over here, probably because we're getting a fairly good rate of return. So they've got an 80-20 asset allocation. So again, we're freeing up all that equity. It's being invested. We can use it for retirement spending. Success rate isn't still 100%, so we do want to see if we can get that a little bit higher, but not bad, 65%, given that they're spending 132,000 a year. There's likely some discretionary spending there. we're probably already in a fairly good place, but let's see if we can get that baseline sort of lower guardrail for them. So let's make a copy and we'll do a bit of optimization unless there's any initial questions, Chris.
Yeah, so for the proceeds, when the program's deciding where to put those proceeds, you talked about TFSA, the non-registered, but if there's a couple, how's it deciding which non-registered? So the question here, I guess the user did a downsize scenario or a home sale scenario, and all the proceeds ended up in one of the spouses non-registered, and they're just
Yeah.
wondering why that happened.
Yeah, so if we look at tax planning strategies here, there is one that is enabled by default, and it's to make contributions to the lower income partner's non-registered account first. So in general, the platform, when it sees that one partner has lower income, it will try to put more of the non-registered assets in that person's name. You can always override it if you want to have more of a 50-50 split for whatever reason, or if there's different income changes coming in the future. But this is likely why we have that sort of everything's going to one person, probably because the platform is seeing that they have lower income at that time. In general, this is more for the accumulation side. When you have sort of one spouse with higher income, one spouse with lower income, general, we're trying to get more assets into the lower income spouse's name, and we're doing that up to the point of the sort of CRA rules. So there's some rules around how much we can do that, but that's likely why. So you could either make an override. So if I go down here to the table, if I scroll to the right, we go to the non-registered account. Um, we could see it here. We're getting more in one person's name versus the other. I could easily override this to 150,000 if we wanted to make it a bit more equal. So that could be one option to do it that way.
And worth taking a look at if you'd like to try the override, see what difference it makes in your lifetime tax situation, in your
Yeah.
success rate, and see just how it affects the overall scenario.
Yeah, see if it does work out better, or maybe it is better to have it all in one person's name.
Great,
Awesome.
thanks, Owen.
So we've got our copy. We're going to do a bit of optimization first before we look at the sort of sell and rent scenario, because we want to try to improve the success rate a little bit. And they did have those questions around what's the best way to sort of optimize the plan, when to start some of these benefits. Now I'm going to ignore the retirement spending, survivor scenario, and asset allocation. We're just going to focus at some of the other strategies first. So we've got CPP at age 70 for James. So that's the top one from an estate value perspective. We can see here it's adding almost $80,000 to the estate value, 75 or so. Let's enable that one. So same success rate, better after tax estate. We've got RSP meltdown. So if we go back to income, again, we sort of talked about this, even though we've got the proceeds of the downsize, it certainly seems like spreading out some of these RSP withdrawals would be attractive. And again, we're adding about $60,000 there to estate value. So let's do that. And an increase in success rate as well. So that's another benefit. So now we're spreading out those withdrawals, mixing withdrawals here. So that's nice. Platform wants to delay CPP for Al as well. So let's enable that one. So another increase to estate value, perhaps a delay for old age security. Jane does have a large registered account, so that might make sense here. But we're getting diminishing returns. Now we're only about $15,000 extra in estate value, 1% for success rate. RSP to RIF conversion, so we can do that here as well. Probably a little bit of income splitting. And perhaps delaying old age security. And again, we're getting a little bit less here, so another $7,000. Let's see what else. So we've got draw enough for registered, so another increase to success rate. Let's do that, spreading out tax a little bit more. And maximizing TFSA, so that's always a good one as well. Lots of non-registered assets. We can shift that into the TFSA. And let's see, and now CPP at 70. So that does increase a little bit estate value. So now we're at 72% success rate. And we could stop there. So now we're pretty close to the maximum. And we could stop there, but maybe let's take a look at reduced spending. Again, if we want to have that lower guardrail, let's see what they would need to do. And we'll just focus on the spending scenario. So it looks like reducing spending by about 6,000 a year gets them over 80%. They could go to the extreme and hit 95% success rate, but again, they've got already a lot of discretionary spending. So it might be a good lower guardrail for them to have spending of about 126,000 a year. So that's a pretty good starting point, and lots of potential upside here as well if they have anything better than the worst case returns. Even the worst 10%, they have financial assets until age 89. So pretty darn strong plan to start with. So that looks good. We've optimized their plan. We figured out CPP and OAS timing, some of the RIF conversion, RSP meltdown, got some nice tax planning here. But let's look at the rent scenario. Unless there's any questions, Chris.
Yeah, a couple of just more general questions. So, one question is, if we're keeping the property, or in this
Yeah.
case, even we do still have a property, what percentage of value is used for the annual capital growth of the property? And they
Yeah.
asked too, is there a website estimating future property growth?
Yeah, good question. So if you click on future dollars, you'll see that the property does increase in value over time. The reason why it looks flat in today's dollars is because we're assuming the same growth as the cost of living increase. So right now, the cost of living increase, CPI we have on the platform is 2.1%. As a conservative assumption, we've assumed the same for real estate growth rate. If it's higher in the future, great, but they're not planning to sell that downsized home in the future here, Al and Jane. So, the impact of that assumption is a little bit less. So, yeah, within the platform, if you're looking at today's dollars, the value of the real estate asset might look flat, but in reality, it is growing with inflation. And if we go down the table here, we scroll way to the right, we can see the home value, both the previous value at the end of the year and the future value of the new home, and it does go up over time, be worth maybe $1 million in the future, but that's not $1 million in today's dollars. That's the same sort of 450, 460. But yeah, good question.
And I think the thing that we would recommend here, because obviously it's hard to know how real estate will change. It can go up, it can go down. This is the same thing when we start talking about rental rates. We make these assumptions and we go forward, and we need to update them as we go. This is why we built the advice platform the way we did, so it's easy to update. And so there's the kind of expectation that we are updating. Oh, my house value is down to 20%, and I'm planning to downsize in 4 years. It's a really big deal.
Yeah.
Or rent rates really spiked as I'm going into the first period of my retirement. So we want to be able to kind of update these dates instead of trying to somehow find the future, the perfect future growth projection, which is a harder thing to figure out.
Yeah, and for Al and Jane here, they're downsizing quite soon. So the change in the relative value of those two properties might not be too different, but we've definitely seen it where one type of property will go up in value more than the other. So it could be that that larger single family home doesn't go up as quickly, but maybe that smaller sort of condo or whatever townhouse does go up a little bit faster. So even the compression of those two values can happen over time. So yeah, updating these assumptions every year, super important, especially if the downsize is a significant part of the plan. So for Al and Jane, it definitely is. But if it was 5 years in the future, we might want to, sort of track and update this every year just to see does it impact the overall assumptions. So
One other question, sorry for you, and this is a bit more general, and we'll look at this a little bit later, perhaps if we get the rental side. But somebody's asking, does the platform handle capital gains tax on the sales, and is the income shown as the after-tax amount of the proceed?
yeah, we'll definitely talk about it. But if there is a capital gain, you'll see it here on the income chart. Yeah, if we have time, we'll take a look at the rental sale scenario because you'll see it right in there. And yes, of course, the platform will look at the net proceeds after the cost of the tax. Now, there's going to be the inclusion rate and what that capital gain will end up meaning for your overall taxes, depending on your other sources of income. So lots of factors that will, make it different from one person to the next. And also, of course, have you started old age security? Yeah, next. So, yeah, in the next case study, we'll talk through that a bit, but Yeah, selling a property with a capital gain when you've started old age security adds a whole nother consideration, which is the loss of OAS due to clawback. So yeah, lots of considerations there.
Thanks, Juan.
Okay, so let's make a copy of this. So we've got our optimized scenario, but they're downsizing and we want to look at a rental scenario. So let's make these changes together. So first thing, we'll go down to the table. We're going to click advanced options down here. It gives you a lot of functionality to make minute changes coming in from discovery and foundation. And specifically, we want to take this purchase date and we're just going to push it out well into the future. Anything past the projections is fine, but basically we're just sort of telling the platform that this sale won't be happening in the projection or this purchase won't be happening in the projection timeframe. So we're going to add that. And we will also come down to the table here and we have in other expenses, we have a sale, we have a purchase cost. We have a sale cost, but we also have a purchase cost. We won't be purchasing another home in the sell and rent scenario. So we're just going to override that to 0. And the only other factor here is that, again, we have this total spending of 132,000. Again, we assumed roughly 12,000 of that every year. 1,000 a month was going to upkeep of the home. If we sell, we have a $1,000 a month that we can put towards rent, but we probably need to add more than that. So let's assume we add another 18,000 a year, which would be about 1,500 a month. So total, they would have 2,500 a month for rent, which increases their spending, of course. So we're just going to add that in here as an other expense. And that's it. Now we'll have a rent scenario. So let's go here to net worth. When we recalculate, now we have no real estate assets, much larger TFSA. From an income perspective, not much in terms of changes. However, you'll notice that the registered withdrawals are a little bit smaller. That's because we have much more income coming from the non-registered account. So the platform will adjust, again, with the RSP meltdown, it will adjust for the other income that we're generating. Spending has gone up a little bit, 144,000, because we've got those additional rental costs. And we can see it's still fairly successful. So 80%, I can't remember, I think we had 81% in the previous one. So similar success rate. However, we don't have that sort of real estate asset to fall back on. So maybe in this case, having that larger TFSA towards the end of retirement might be a little bit more necessary just in case there's additional long-term care costs, et cetera, that we might want to pay for. Success rate, again, looks fairly similar, a little bit earlier in terms of some of these running out of money, but similar in terms of overall success rate. And definitely more tax. I don't think we had it before, but 764,000. If we go to the previous one, 700,000. So definitely more tax because we have this much larger non-registered account. So different considerations here, of course, less estate value, more tax to pay over time, more spending because we have those rental costs, but a lot of flexibility here. So, I mean, again, pros and cons, really big investment account. Now we've got a total of almost 2.5 million in investments. So more complexity there, but more freedom in terms of just where they can sort of live in the future. So definitely some pros and cons. Anything I missed on the sell and rent, Chris?
Um, we just had a question here which said, is there another place to input rental cost expenses after you sell a house and before you buy a new home? They tried using the mortgage cell, but maybe that's a bad idea.
Yeah, mortgage isn't a good spot because that's looking at the debt. You could use other expenses like we did. There's also a miscellaneous. So if you go to personal, there's a miscellaneous amount here as well. So either one would be fine. Other could be a good spot because you can make a note here, maybe in comments of what that's for. Now in the profile, if you had indicated, so if you don't want to model a downsize at all, if you just have a plan to sell your home in the future and not to purchase, then the platform will actually add a rental field for you. So it'll have, mortgage, property tax, etc., but it'll add that rental field because it knows that you might have rental costs in the future. But in this case, we're trying to model multiple different options within one plan, so we have to add it to other expenses.
Thanks, Owen.
Okay, so we've got our downsize scenario. We've got our sell and rent scenario, both looking fairly good. Now let's take a look at the HELOC example. So this one we've already got set up. We're going to talk through it here quickly. What we want to highlight is that it could be a mixture. So here we are selling the home and renting, but we're trying to stay in the home as long as we can. So originally we were selling quite early. We saw the benefits of that, the larger non-registered account, etc. Here we're trying to stay in that home as long as we can, and we are potentially withdrawing from my home equity line of credit for a few years to make that happen. So let's take a look at how we set that up. So we go down to the table and we scroll all the way to the right. We'll have our debt sections. We've already got a home equity line of credit, which we've set up in Discovery. If you've already got the home equity line of credit set up before you retire, you just add it to Discovery debts. There's no balance there. You'll add the interest rate. And if I scroll down, what we've done is we've just made some withdrawals. So a positive would be a positive payment, would pay down the principal, and a negative override here is a withdrawal from that debt facility. So from the home equity line of credit, we're taking out 75,000 a year. And then here we've got home value. We sell the home at age 80 and we pay off that home equity line of credit. So we just add an override to pay off whatever balance was there from the previous year. So fairly easy to tap into a home equity line of credit. You would do the same thing with a reverse mortgage, but it might be a bit different. You might have a large lump sum all at once. It would go into your accounts, or you might withdraw from it over time. It might have a fixed interest rate or variable, lots of considerations there as well. But that's all we would need to do to sort of draw on that debt and then pay it off once the home gets sold in the future. It does give us the option of staying in the home a bit longer, maybe not quite as successful, looks a bit different. There's some costs there to borrow for those few years for sure. So not quite the same success rates, but this might be the right decision, if they want to stay in that home as long as they can.
Owen, do you mind? We did have a question just specifically about the reverse mortgage scenario. Do you mind just kind of going and showing how we might set up that debt source in Discovery, the call to reverse mortgage, and just kind of outline a little bit more kind of how they would set that up if they want to run that?
Yeah, so let's go up to Discovery Debt here. So we've got our home equity line of credit. Again, there's no outstanding balance. They're not using it right now. We've got our interest rate. So we could add another one. We could say that it is a reverse mortgage. We'll say that, yeah, we could call it a home equity line of credit. We'll say that it's joint, zero outstanding balance. Maybe the interest rate is different, no payments. We can say that it's monthly. So again, we're not repaying that reverse mortgage until we get to that point where we sell the home. So let's go back to projections now. And we can go to that same scenario. So let's go to the home equity line of credit scenario. And let's scroll down here to the table, and then we'll just go all the way to the right till we get to the debts. So now we've got a reverse mortgage here. If I scroll down, we've got our home equity line of credit, and we've got a reverse mortgage. So perhaps we're taking out 250,000. We're not doing subsequent withdrawals. Let's get rid of these overrides. We're going to do that until age 80. And then maybe in the year of the sale, age 80, we have to repay it all. And I don't know exactly what it's going to be, but I know it's going to be probably less than 500,000. So we're just going to add a much larger override, and the platform will cap it based on whatever it needs to repay that that reverse mortgage. So let's recalculate this. We'll go back down here. And so we've got the debt, the reverse mortgage, we've got it building up based on that 6% interest rate. and then we're repaying obviously a slightly larger amount here due to the extra interest. And that's just going to come from the proceeds of the sale of the home. So either one can work. You can add it as a lump sum withdrawal. You can add it as 75,000 a year for 3 years. Either one will work depending on what sort of debt facility you're using.
Great. Thank you all.
Okay, let's see if we have time to take a look at the rent scenario, the rental sale. So let me flip over here.
Yeah, as Owen's flipping over there, just feel free to keep questions coming. And if there's something you want us to go over again or kind of that we didn't talk to on the PR side, principal residence side, just let us know.
Perfect. Okay, so let's talk rental. So often we'll see this. We'll see a client that has two, three, four rental properties and may not have a lot of investment assets. And as they approach retirement, the question is, do we keep it with the cash flow? Do we keep and cash flow those properties? Um, or do we sell and invest the proceeds? Big decision again, because sometimes they have a lot of equity in real estate, but not a lot of investment assets. And there may not be a lot of experience there with investing. So again, both we've got the financial side of this decision and then also the sort of personal practical sides of this decision. Now, rental properties, we're producing rent. There's a tax consideration there. If we keep that rental property, we've got that rental income over time. And if we sell it, we've got this capital gain we need to worry about. So when is that sale going to happen? Does it happen before retirement when maybe there's other income? Does it happen early retirement when maybe income is lower? Or does it happen later, but then maybe we're triggering old age security clawback? So again, very important to decide when are we selling some of these properties. Now, rental analysis is also important. So let's say you have a few rental properties, which one are you selling and when? So we might look at cash flow from the property. How much is the sort of free cash flow from those different properties? What's the cap rate, which is essentially looking at the rental income versus the sort of property value without any leverage on the property. We might look at cash on cash return, which is the sort of rental income versus the net cash that's been invested in the property, so including leverage. And then we might look at including appreciation as well. So that might be the last one, is just, what's the potential for increase in property value? How does that factor into the rate of return? And if you've got a highly leveraged property, that cash on cash return can be easily 10, 20, 30% potentially. So need to kind of look at all of these factors to understand, are we keeping or selling these properties? In the platform, we'll take a look at rental property analysis briefly, but again, we can look at the different cap rates, cash on cash return, and then we want to look at capital gains. So big consideration on the sale. How much is being owned? Have you taken any deep depreciation on the property? Is that going to get recaptured when you sell? Lots of consideration there. Is talk to your accountant, see what you've been doing for CCA depreciation. Um, Also, the sort of risk of rental ownership, and what's the risk profile of that sort of rental owner. So again, sometimes investing in real estate can seem more conservative, less risky. And so there's always that consideration of how are those proceeds going to be invested, um, and the time and energy put into owning and owning that rental property. So again, might be something that you want to do as you're sort of accumulating assets, but in retirement, there might be other ways that you want to spend that time and energy. So definitely a lot of considerations there, both financial and the personal side as well. So we've got Ted and Sue here. They want to retire in 3 years. I think they've got 3 rental properties we'll see. And the question is, do we sell 1, 2, or 3? How much do we need to support retirement spending? And if we sell, we don't have the cash flow. So is that enough? The equity, is that enough to support retirement spending goals? Financial assets, much less than the previous example. We've got $600,000. They're 60-40 investors, so more conservative, like we talked about, invested most of their money and assets into real estate, and they've got 1.7 million. So 3 properties, 1.7 million, and detailed cash flow positive properties. So we're getting net cash flow out of those 3. Okay, let's flip over to the example and let's walk through the sale. And this should be fairly quick here. So we've got our keep scenario. Let's start with this one. So lots of real estate equity. However, we can see that with spending, and their spending is fairly decent, 176,000 a year. They've got lots of income, lots of kind of cash flow. They've got their investment assets, definitely a good position, but they are running out of financial assets towards the end of the plan. So clearly, if we want to support this retirement spending, we need to look at selling one of those rental properties. And we could be forced into that quite early depending on investment returns. So it could be as early as kind of 75, 78. We might just have to sell a property to keep spending at that level. So let's flip over here. Actually, let's go to foundation first. We've got rental property analysis, which could be valuable if you've got multiple rental properties. We've got the current value, so 320, 500,000, 880,000. And if we scroll to the bottom after we enter all the rental property values, we've got cap rate, cash on cash return, cash flow. We can see that this middle property, number two, not great. Maybe it's the value of the property's gone up significantly. Maybe it's just that there's perhaps maybe a long-term renter in there and they haven't been able to increase to market rate rents. For whatever reason, we've got a lower cap rate, and that might be the one we want to look at selling. So if we go to selling a house, we can scroll down. We've got our property two sale assumption. So 500,000 first year of retirement. We've got some cost of sale there. And then when we go to the projections, we'll take a look at what this looks like. So we've got here that capital gain we talked about. So it is indicating we'll have a bit of a capital gain, but because we don't have old age security yet, that's not a concern. We don't have a lot of other income. So again, tax is fairly low. So probably a good time to sell. Spending, we've got a large proceeds of the down sale. So that all sale of the rentals, so that all needs to be invested. And then from a net worth perspective, now we've got a lot of liquidity. So we've got less income because their rental income goes down. Wasn't a great cash flowing property anyway, so it's not a huge impact. But we do have a lot of liquidity now that we have the downsize. So TFSA goes up a bit. Most of it ends up in a non-registered account here. And now they've got lots of room to absorb that extra spending. So success rate is quite a bit higher. Maybe in some scenarios they still have to sell a second rental, but there's a fairly good chance that they can make it to the end of retirement without having to sell anything else. So this looks fairly good. It's captured the tax impact. They're still fairly conservative investors, so we're not getting a huge rate of return, but we're still getting the cash flow from the two remaining properties. Any questions on that, Chris?
No, not so far.
Maybe what I'll just highlight down below in the table is if you are modeling out the sale of rental properties, you'll want to open up these income columns and just triple check that the rental income is stopping at the right point. So you might need to actually override this, cascade it, past the end of the plan. And you might need to do that for if it's owned by both spouses, you might need to do that for both of them. Now here we've already got the rental income stopping, but just as an example, we want to make sure that we're stopping that there as well. And same for expenses. So we might go through and zero all of these out if for some reason it's not like that, set up like that in Discovery. So by doing that, we can just make sure if we wanted to sell another rental property in the future, we could also do it from advanced options here. We could set the sort of sale date in the future for any of these other properties. So we could have multiple scenarios with different sell and buy times, lots of options here as well.
Yeah, just to say what Owen said in a slightly different way, it is not automatically linked, the income and the expenses of a rental property, to the sale of that property. So clicking the sale of it is not going to automatically stop those things. You need to make sure that that is either done in the discovery phase using snapshots or with the override like Owen just illustrated.
Yeah, not yet anyway. It is on our feature request roadmap. So we will get that. We'll have it linked and then it'll do it automatic. But yeah, Chris is right for now. Make sure those expenses and income stop when you plan to sell that property.
And it's the same thing with your principal residence. So if you're selling a principal residence, it's not going to take away those expenses. It's not going to shift those expenses. You have to kind of get in there and do that manually or in the discovery phase.
Excellent. Well, we got a few minutes left. Any other questions at all, Chris?
Doesn't seem so. So feel free if you have quick fingers, you can type a last question in here as we close up. But if not, I'll do some housekeeping. So next, we do 2 of these webinars a month, one office hours session for open questions and one more case study session. In May, we'll have our office hours session fairly in the beginning of the month, and then we're going to be focusing on lifetime tax, which will be really fun. And if for some of you who've had a chance to play with the new AI strategies around lifetime tax and the new lifetime bar menu where you can see the lifetime tax, we're going to start playing around with some of the metrics and levers that you have to shift that, what you could focus on, and also where there's a detriment to kind of focusing too much on tax to the perhaps cost of other things. We had one question that just snuck in here at the end here when they asked, when will we expand to more than 5 rentals?
Oh gosh. Yeah, good question.
I think it's the first time we've been asked.
Yeah. Yeah, we do have five. So there's different ways around it right now. We just rolled out up to 5 rentals, but yeah, shoot us an email or post on the community forum and we can kind of walk you through how you might model out the yeah, the other rentals. Yeah.
One last question, not specifically on real estate, or perhaps it is, but it's talking about the current value of assets and investments. Should they be updated January 1st of each year to have things map out with the more current data?
Yes, yeah. So there is I think we did a webinar a while back in January. It might be in the help resources, but yeah, we do recommend updating every January, February. Great time of the year to update the platform. Now, if markets go down, like we've kind of seen, you could definitely do that during the year as well. So we did talk about that previously last year, but during a market correction, you might want to kind of update those values and just see if there's any significant change to the plan. We might always see a recovery, but it could be a good option just to see, it may not be as bad as we think in terms of yeah, correction and the impact on the retirement plan. Um, yeah, perfect.
And a perfect tax season question to end us off. Somebody is wondering where can we find a receipt for the annual advice subscription?
Oh yeah, if you go to the account section, there's a billing portal. And you should see in the billing portal all of the receipts and invoices should be right below in the billing portal.
Perfect. On that note, please participate in the Reddit forum if you have questions going forward. Thank you so much for joining us. We're just going to drop the Reddit forum in the chat just in case you haven't found it yet. And you can also find a lot of resources here on our help site. I've linked a couple of articles, but there's the help site. Thank you so much for coming. Keep the suggestions and feedback coming. And if you want us to do a case study just like you, send something our way. We'd love to do it. So have a
Excellent.
great rest of your night.
Thanks, everybody. See ya.